This is Al Brooks. Thank you for watching the Brooks Trading Course. This is a preview sample of a video on trading climactic reversals. A climactic reversal is a failed breakout. Whenever a breakout is weak, it usually means that the market will soon evolve into a trading range. Breakouts can succeed and therefore become measuring gaps, or they can fail, in which case they then are exhaustion gaps. I'll finally talk about characteristics of strong and weak bulls and bears. Something I'm always watching is whether traders taking the opposite trade are making money. So on a bull trend, I'm always paying attention to whether or not the bears can make money and how they can make money. Can they make money with stop orders, stronger bears, or only with limit orders, weaker bears? And here we have a bear trend, and I'm going to pay attention to how the bulls are making money. They're making money here with a limit order below that bar. And maybe they made money with a stop above this bar. I don't know. I don't think they did. I don't think it went up enough for them to make money with a stop. But if the bulls are making money with limit orders, buying below bars here, buying below bars there, then we're in a trading range and not a strong bear trend. It increases the chances that the market is evolving into a trading range, or at least a pullback. Bulls buying that low, they made some money. Chances are sideways or a bear leg in a trading range. What about down here? Same thing. We have a sell climax with a doji inside bar, probably bulls buying that low. And limit order bulls will start buying below bars. They bought below this bar. You can see it went below and it turned up. They'll probably buy below this bar, betting that these dojis are the start of a tight trading range. They'll buy that low. They'll place a limit order to buy more 10 pips lower, 20 pips lower, betting that the selling has stopped and that will at least go sideways. And you can see they can make money. They buy with a limit order at that low, and it went up high enough for them to make money. It went up 11 pips below that low, so they could scalp out with 10 pips. So the bulls are making money in a bear trend. The bear trend is not very strong. It's probably evolving into a trading range. And it did. And ultimately, we got a stronger reversal later on. Early in a session, whenever you see a lot of small bars and a lot of reversals, it usually increases the probability that you're going to have a lot of trading range price action for the rest of the session. This is California time. This is midnight California time. And this is the end of the Asia session, the start of the European session. They overlap. Trading range price action here, small bars, the absence of consecutive big bars. And then here, when the European session is opening, we have bear bar, weak follow through, bear bar, bull bar, bear bar, bull bar, bear bar, dojis. This is also trading range price action. And whenever you get a lot of trading range price action early in a session, it increases the chances that there will be a lot of trading range price action for the remainder of the session. This trading range is only about 15, 20 pips tall. So it's about half the size of a typical day, maybe less than half the size of a typical day. And you expect the range to get bigger. This is the start of, or near the start of the day. The Asian session is the beginning of the day. And the day can get bigger by breaking to the upside and going up, breaking to the downside and going down, or breaking to the upside and then breaking to the downside. Here we have a trading range, and it's also a bull channel, bear flag. So you got to be looking for a reversal down, strong bear bar here, and then basically a micro double top this high and that bull bar. So this is a short, but the sell-off lacked consecutive big bear bars closing on their lows. It's probably a bear leg in what will become a trading range rather than the start of a big bear trend day. By weak breakout, what I mean is Yes, we have a breakout below the bottom of the bull channel, but bad follow through. Another breakout bar, bad follow through. Another breakout bar, bad follow through. That usually does not happen if this is the start of a bear trend day. When you see that, it's more likely a bear leg and what will end up as a trading range day. But if it is a trading range day, you got to be thinking that pullbacks are deep. So wherever the bottom of this leg is, there probably will be a deep pullback. Bull breakout above the trading range, bear breakout below the trading range, bull breakout, deep pullback here. This is trading range price action, and this warned about that possibility, and then this sell-off also warned of that possibility. A breakout can succeed or fail. If it succeeds, it becomes a measuring gap. If it fails, it becomes an exhaustion gap. Now, a climax is an acceleration of a move up or down. So buy climax, sell climax, sell climax, sell climax, buy climax. Every trend bar is a climax. Every trend bar is a breakout. When people use the term climax, they're talking about an accelerated move, an extreme change in behavior. And as I said, every bar with a big body is a climax. Every breakout is a climax. Buy climaxes in green, and then sell climaxes in red. But most of these climaxes are minor. Here we have a sell climax. Did it result in a bull trend? No. Another sell climax. Do we get a bull trend? No. Buy climax. Is that a bear trend? Not really. So most climaxes are minor and just lead to trading ranges or small reversals. You can see the video on trading in trading ranges and in broad channels for more information about that. Whenever I see a big bar on a chart, my first thought is, okay, there's a gap between the close of that bar and the low of the prior bar. Here, the close of this bar is below the low of the past 20 bars and is way below the low of the past 20 bars. But anytime I see a big bar, there's a gap, and it could lead to a measured move. It could be a measuring gap, but it could be an end of a move, an exhaustive end of the move. So an exhaustion gap. Every time I see a big bar breaking out of something, I'm asking myself, is it more likely a measuring gap or an exhaustion gap? Is it a measuring gap and the start of in this particular case, is this a measuring gap and the start of a big bear trend? Or is it an exhaustion gap and just a failed breakout? So we got a big bear breakout closing on its low. And like I said, there's a gap between the close of the bar and the low of the bar before it, and the low of this higher low, and then the low of the entire trading range. Many ways to look at the gap. And look at this reversal up. It went above the breakout point here and above that breakout point. It even went above the low of the bar before the sell climax. So big down, big up, big confusion. A big down, big up pattern usually results in a trading range. Trading range typically has deep pullbacks. So yes, we have a climactic reversal, but that does not mean bull trend. And you can see we tried to reverse up here, but a bear bar, disappointing. Consecutive bull bars, but a bear bar, micro double top, disappointing. So even though we have a climactic reversal, it's a minor reversal, leading to a trading range instead of a bull trend. At this point, we're getting a bull breakout again. We got 5 consecutive bull bars occurring a little bit late in a trend, about 10 or 15 bars into the trend. And you can see the gap between the high and that breakout point, this breakout point, and then the high of the final bar of the trading range. And this particular gap got a second leg up. In fact, it went up for about a measured move based upon the open of the first bar, close of the final bar of the breakout, maybe a measured move based upon a bull breakout above a double top. This is a gap, pullback above the breakout point. Bear breakout here became an exhaustion gap. Bull breakout here became a measuring gap and the start of a measured move up. Bulls can be weak or strong. Bears can be weak or strong. I'm going to be talking about characteristics of weakness and strength. Unfortunately, weak bulls, beginners, they see this bar and they bet that it's the start of a swing up. They see this bar, they bet that it's the start of a swing down. Especially this bar, this is a really high probability, well, at least 60% chance that it's at or near the end of the move. But you got weak bulls who look at that breakout bar and they say, wow, it's finally getting strong. I'm going to buy that close. But there are not enough weak bulls out there to make the rally continue. And in fact, there are a lot of strong bears who see it as a gift and they're selling. You have weak bears selling for any reason, sell here, and they use some crazy wide stop. And they sell here, a low too short, leg one, leg two, ignoring all the bull bars. They sell these highs, they sell above this high, they sell, at that high. And at some point, they just can't take the pain anymore. They're just saying, it should have turned down here. It should have turned down here. I got to get out. This is too much risk. So you get weak bears giving up here. But that's the exact opposite of what the strong bears are doing. Even the weak bears understand that it might be an exhaustive climactic end of the move, but they just cannot take the pain anymore. And they're just so afraid that we have a gap here, this low, that high. Maybe we'll get another measured move up, this low, that high. They know the probability is that we will not, but they just can't take the risk. They're probably already risking more than what they typically want to risk. So the weak bears, when they see this breakout starting to form, they're just giving up. So you got weak bears buying, and you got weak bulls saying, oh, wow, we're finally getting strong. I'm going to buy. But that's the exact opposite of what experienced traders are doing. The weak traders, the beginners, they don't understand that the breakout might in fact be a climactic end of the move rather than the start of a new leg up. If you're a weak bear, you just cannot take the pain. Your loss is so big and it's growing fast that you have to buy back your shorts. Once the weak bears have bought back their shorts and the weak bulls have finally bought, there's nobody left to buy. Are the strong bulls going to buy up here? No, they bought down here, right? And what are the strong bears going to do? They're going to sell. Are they going to buy back their shorts? No, they're strong. They're never going to buy back their shorts. If it goes up more, they're going to sell more. There's nobody left to buy. The weak bears are all gone. The weak bulls are gone, and the strong bulls are only going to buy a pullback. So there's nobody left to buy, no bulls left to buy, and no bears left to buy. So there's nobody left to buy. The market can't go up. It has to go sideways to down. I'm Al Brooks. Thank you for watching this preview sample on trading climactic reversals. A climactic reversal is a failed breakout.